Welcome to our next and final lesson in this introductory module of the course. We're going to be discussing what makes financial modeling hard in this lesson, because if you followed everything we've covered so far, you might be thinking, this doesn't seem that difficult. We have a few simple formulas and we can evaluate any company or asset or investment opportunity with those formulas. So why do we need all these other modules and case studies and lessons if it's that simple? Once again, you can certainly look at the written guide. This is going to be a very, very short lesson. So on the last page or two of the key rules section there, we lay out a lot of what we're going to cover in this lesson. The key question you should think about is what could make this formula, company value equals cash flow over discount rate minus cash flow growth rate, so difficult? The first answer is that this formula does not always work, because for this to work, the company must have reached stability. So if you're going to value a company's cash flows like that, take the present value of their cash flows to figure out what the company's intrinsic or implied value is, these metrics, the discount rate and the cash flow growth rate, cannot be changing by very much. And then the second answer is that even if you accept and understand that, and you make your own projections and you come up with your own methodologies until the company reaches stability, it's still tough to come up with reasonable numbers for everything in this formula. Estimating the discount rate alone is quite controversial. Entire textbooks have been written about how to do it. Different people disagree, different groups and professors and academic sources disagree. So just on one small component of this formula, there is a ton of literature and other sources written about what to do. In this lesson, we're going to cover 4 specific points that make financial modeling more difficult. First off, there's the matter of finding the data. Second, there's the matter of projecting the items for use in this formula or other related formulas. Then there's the matter of what company value means. We've been very vague about it so far, but we need to be a little bit more specific when we actually value real companies. And then fourth, is the fact that there are other factors outside of this formula that will also influence a company's value or a company's appeal as a possible buyout candidate or a candidate for raising equity or debt or other forms of capital. Let's go to the first issue here, finding the data. No company discloses what its cash flow is or what its discount rate is. So that alone creates some extra work because it means that you have to comb through the company's public filings and probably look at other similar companies in the market, look at their filings, and come up with an estimate based on what you see in the SEC or other government-regulated filings. Now, this may sound easy, but this process could require a lot of manual adjustments because you have to go through and literally decide whether to include or exclude all the different items that are listed there. Just as one example, for this company Steel Dynamics that we cover in the valuation and DCF lessons, we have to go through the company's financial statements and highlight items that should be included and then exclude the items that should not be there. And it's not as simple as just looking at the company's cash flow as disclosed on its filings, because a lot of what's in there may not actually recur from year to year. It might only be available to certain investor groups or individuals, but not others. So there's quite a lot of subtlety in just what goes into this and how to find the data in the company's filings. This topic is covered in the accounting and also the valuation and DCF modules, and we go through several examples of how to move from a company's financial statements to its cash flow and how to come up with reasonable estimates for the discount rate. The second issue is how to project items in this formula. As I mentioned before, most companies haven't stabilized, so their metrics are going to be shifting around for several years at least until that happens. Now, you saw an example of this earlier in the previous lesson when we went through a real-life valuation of a company, and you saw how the cash flow growth rate went from 10% down to 3% and then stabilized at around 2% in the terminal period. And that's all well and good, except for normal companies, it's more complex than that because you have to actually estimate their revenue and expenses and use those to derive the company's cash flow. And you ideally want to use units sold or per unit expenses or the employee count rather than just simple percentage projections. Here, we use simple percentages and said that cash flow grows at 10% or 9% or 8% just to introduce the concept. But in real life, when you're dealing with a valuation, you might look at the total market size and the number of patients on a medication if it's a healthcare company, for example, and then you have to estimate the pricing, and then you have to use all of that and come up with how much it costs to actually sell these drugs and how sales reps are compensated. And so the entire process gets considerably more complex than just simple percentages. You also have to make sure that revenue, expenses, and other items that impact cash flow follow reasonable trends. Most companies tend to slow down their growth over time. So if you have a company where growth is speeding up and then slowing down and then speeding up again, something is probably going wrong. You probably need to step back and think about what you're actually doing and come up with more reasonable numbers. This topic is covered throughout the entire course, but it's certainly there in the accounting and three-statement modeling lessons and modules, also there in the valuation and DCF lessons, and even in the M&A, merger model, leverage buyout, and debt and equity lessons. You will see this topic because we almost always project the company's revenue and expenses. The third issue here is what company value means. We've repeatedly used company value in our all-important formula, but we haven't really explained what it means. Are we talking about the company's value to all the investors, debt and equity, and possibly other types of investors like preferred stock investors, convertible bond investors, even parties that hold leases with the company, for example? Or are we just referring to equity investors, or are we talking about some other group? Also, what exactly are we including in this number? Are we listing everything the company has, or only the assets that are related to the company's core business? If we just say company value, we're not being very specific about what it includes or to whom it's available. You normally deal with this issue by calculating two metrics called equity value and enterprise value, which are used to measure company value, and they differ in the investor groups and the assets that they refer to. But just these two concepts will require quite a bit of explanation. So we cover this topic in Module 6 on equity value, enterprise value, and multiples, but you'll see it throughout. For example, in almost any valuation, we'll go from enterprise value to equity value or from equity value to enterprise value, and we'll use both of them together to think about companies' valuations as we move through the course and look at different topics. The fourth issue is that sometimes other factors outside of this formula can affect your results. For example, in a leverage buyout where you buy a company, run it, and then sell it, it's much more about the IRR or the potential returns versus the targeted returns. So in a sense, the formula still applies because, as you know, a company's asking price and discount rate and cash flows and IRR and all of those are related. It's just that you tend to focus more on the second method for evaluating a company's value in a leverage buyout scenario, the potential returns versus the targeted or expected returns. If you're looking at a merger or acquisition, it's similar. You could look at the IRR versus the targeted or expected returns, or the company's own internal WACC, for example, but you also care a bit more about accounting-based metrics such as earnings per share. These often have almost nothing to do with cash flow or recurring cash flow or anything like that, but you still care about them because companies have to present these metrics to investors and the markets as a whole, and so they come up and are quite important. If a company is raising equity because it needs to grow its business or make an acquisition or expand in some way, investors care more about this IRR versus potential returns question, though they also do still care about valuation somewhat. And the company itself cares about minimizing dilution. So they don't want their existing investors to go from a 90% stake to a 50% stake after they raise additional capital. They want to try to reduce that a little bit so that existing investors still feel like they are on board and they have some control over the company's direction. And then finally, with debt issuances, here you care a lot about metrics and ratios that point to the company's ability to repay debt. For example, you could look at metrics and ratios such as the amount of debt relative to equity the company has, the amount of debt relative to total capital. You could look at metrics that measure their cash flow relative to interest payments on debt or their ability to repay and service debt. These types of metrics and ratios become a lot more important in debt analyses because you focus on what could go wrong and you see just how bad things could get and if the company would still be able to meet its debt repayment obligations there. So this one, of everything here, probably has the least to do with that all-important formula, although as you'll see later on, there are still some metrics that relate to it. Let's do a recap and summary now. The all-important formula that we learned does not always hold up, and there's more to valuation and financial modeling than that because of the many issues we cover here. One big issue is finding the data. It's not so simple to get a company's cash flow growth rate, and discount rate because they don't disclose it. It's up to you to go through their filings and calculate it and estimate these numbers. Projecting the items can also be challenging because you have to figure out the company's revenue and expenses and what they're paying for units, how much they're selling units for, how much they're paying employees, and you have to make sure these follow reasonable trends over time. Company value gets complicated because there are different ways to measure it depending on which investors you're including and which assets you're including in this number. You often have to move between different versions of company value and move back and forth and back into different numbers based on this. And then finally, sometimes you don't care about the formula much at all because you're more worried about how a company's earnings per share might change before and after something, or you're worried more about the company's ability to repay debt and if it could do so even if the business goes through a downturn, for example. So these are the reasons why there is a whole lot more to the course than just these introductory lessons. These provide a good setup and a good conceptual understanding of everything else we're going to do, but there's quite a bit more that goes into financial modeling than what we covered here. And we're going to get into that next, starting with some accounting-focused lessons, and you'll learn how to move from a company's financial statements and what their accountants and auditors report to their cash flow, their discount rate, and their cash flow growth rate, and other metrics that we can use to value and model them.